All right, let's prepare the reports needed. So now that you've identified your top pain points, step 2 is all about confirming and measuring them with the right data. Start by pinpointing the measurable metric, like Gary went over in step 1. It could be cash flow, return rates, holding costs, whatever fits. Then pull one report that clearly reveals a problem. Don't overdo it. Focus on decision-driving reports, not data overload. We use simple tools at Ledger Lab. Google Sheets, dashboards, QuickBooks exports, they all work great. And wherever possible, make it visual. The trends and charts beat raw tables anytime. So we want to keep it clear, keep it actionable, and that's how we'll go from guesswork to insight. Now let's take a look at a couple dashboards that we've prepared for our clients. This system was made through Power BI. So these consolidate key metrics from across the business. It can be from the finance, operations, marketing, all in one place. So instead of jumping between platforms and initial data sources, you get one single set of source of truth where everything from ad performance to inventory movement to cash flow is tracked in real time. Each dashboard is tailored to the business, pulling multiple data sources through a back-end warehouse and visualized in this example through Power BI. Going to look at another dashboard here. An intricate part of building a dashboard is lining up the real-time data. With the help of Synder's platform, all sales figures in this dashboard, as well as this dashboard, are updated to the minute that a sale is conducted. Dashboards don't need to be overly complex or intricate, as I said. In fact, most of the pressing pain points can be effectively tracked using something as simple as Google Sheets. The key here is clarity, not complexity. So Gary, let's go through the reports that are needed for those examples that you covered in step 1.
So let's take the first problem about the cash. So whenever I'm encountered with this question from our clients, right? So I immediately look into the cash flow statement. Cash flow statement is where you'll get most of your answers. So cash flow statements typically gets broken down into 3 sections: operating, investing, and financing activities. And this precisely tells you where the cash actually went or is coming in from. Ideally, every business should have the cash coming in from operating activities. Under operating, if your account receivable is climbing, as your cash is sitting in someone else, that's something like cash sitting in someone else's bank. If inventory is piling up, that means you are tying up too much money in your inventory, right? And if you are paying your vendors quite fast, your AP balances are almost zero, they're getting negative. That means you are paying too much to your vendors quickly. So if investing section of the cash flow statement, cash might be tied up in things like new equipment or software license. These are often necessary, but they reduce short-term flexibility. Good part is that you can be comfortable thinking that these are like one-time expenses. You can be comfortable assuming the fact it will not be the same next month. Under financing, you might be repaying loans or taking honors draw, both of which don't show up on your P&L, but do really hit your bank account hard. Again, this is one of the sections that most business owners confused with. I have seen my clients telling me that, Gary, my bank account is flushed with cash and I don't have any cash flow problems, until I figure out that they're getting all the money from the loans. And this is not their money, this is someone else's money, which they eventually have to pay out. One of the latest trends is being financed by sales-backed financing. Like, I'll not take the name of the agencies, but they are not solving your problems. They are just delaying the problem. They are just, instead of being having a death by one blow, they're making 1,000 cuts into your cash flow to make it bleed. So you have to be really smart with this section. This is graveyard for most of the businesses. Now, if your business feels profitable, but cash is tight, this is exactly the report that you should look into. And if you go deeper with related reports like inventory turnover, AR aging, interest expense to find exactly where the cash is stuck. Remember, not one report can give you the entire picture of the business. You have to relate multiple reports in order to come up or create a final logical picture for your business. Second is, let's talk about, we are being overstocked, even though sales are strong, and we are buying carefully. So this is, there are multiple culprits for this, but I would touch the part of returns. This is something, that we recently I would solve this problem for a client, and I was quite amused with this, how returns can really impact the business. So returns typically don't just cancel a sale. It's not like only the cash flow impact, but there's also a domino effect on all your silent costs and especially your profitability. So take a $60 product like with 20% return rate. Between shipping both ways, labor to inspect, restock, damage items, you could be losing like $10 per return, shrinking your ROI by as much as 10 to 15%. Most businesses that I have seen, they stop at inventory aging reports, this inventory is being stuck in my warehouse for so much time, so let me get rid of this inventory. That's surface level. Most accountants or the most books that come into us, coming up to our doors, we see that the accountants are reconciling all the shipping costs directly as shipping expense on a cash basis. Even though they'll add a bill, that is almost incorrect. And if you want to know the reason, you can ask me this question in the Q&A session at the end. At Ledger Labs, we go deeper, right? What we do is we pull all the shipping cost reports to capture return freight, labor and restocking reports to quantify resources consumed at warehouses, return damage reports to measure unsellables or lost inventory, cash conversion and working capital reports to show how returns slow your cash cycles, marketing ROI and LTV versus return rate to expose inflated customer acquisition cost and reduce profit per customer. We also incorporate returns into inventory forecasting models, and that is how we are able to accurately forecast our inventory forecasting for our clients. Bottom line for this, returns don't touch just operations. They ripple across finance and marketing. So if you're not analyzing them holistically, you're leaking profit in each and every department. Third example, margins on paper look strong, but they're mainly making profit. That one's is sneaky. Your margins look great, but many times, again, there are a lot of reasons. I would touch about some unusual reasons, which is capital inefficiency. So start with the question of inventory turnover ratio. So if your product sits too long and you're not turning fast enough on investment, then review your inventory holding costs like warehousing, insurance, shrinkage. All these add up to the cost of product as it sits in your warehouse. Look at the ROI by product or category. You might find that the same profitable product is actually not profitable when you do calculate your cost of capital, the sales velocity, and a lot of those things. And don't forget interest or financing expenses. If you're buying stock or with credit or loans, that's interest money that's quietly eating away your margins. There's no deductive and strategic work. There's no single report, no single strategy would work. So every report you should pull should confirm or challenge your gut feeling, that should challenge you. And here's the secret. You don't need 50 reports, by the way. You just need 4, 5, 6 key reports, which can give you sufficient picture. The value of the more reports that you'll bring in will drop as you bring in more reports. There's not much realized value after a certain point in time.